Let's start. So my name is Matthias, and today I have a webinar with you about the topic of optimal position sizing. So in most cases, beginners and also advanced traders don't know how to apply this in a perfect manner. And today or tonight, I want to show you how to calculate the optimal position size for your trade. And yeah, first of all, the disclaimer. Oh, this is the German one, but yeah, everything I want to teach and talk today. So it's not a recommendation for trading. It's just about teaching. So don't copy this in real money without any knowledge. So yeah, be careful. So this is everything you can read here in German. So yeah, I've forgotten to replace this with the English text. Okay, but now this is in English. Calculation of the perfect position size for CFDs. And tonight we are only talking about CFDs, so contract for differences, because in all other contracts, for example, futures and options, we have very different multiplier. And this makes things much more complicated. And yeah, this is the reason why we are focusing on CFDs. And it is also very easy because a lot of beginners and a lot of people with a tiny or small account can only trade with CFDs. So this makes absolutely sense to talk about CFD trading in combination with the calculation of the perfect position size. Once again, if you have some questions, please use the chat box and I will have an eye on it and answer you as soon as possible. Okay, and of course we will do a lot of practical examples, and for this I need your help. So you can give me some numbers and then we can calculate the perfect position size together, just as a little practice for you guys for the future. What kind of steps do we need to calculate the optimum position size? So the first one is the absolute risk per trade. We need to know how much we want to risk. Then the second one is we need to know what is the space or the room between the entry level and the stop loss level. And the third and final step is calculation of the position size. It's very, very simple, and every one of you can do this with a simple Excel sheet or even just in your head without any calculation, because it is so simple in most cases. Okay, then the next one, account size and risk per trade. So this is the first step of calculation. So you should ask yourself, how big is the account? So what is the account balance? Then the second one, what is the maximum risk in percentage per trade you want to risk? The third one is, what does the percentage risk means in dollar terms? So you can see this three simple examples below. So the first one is, imagine you have an account with $400 and you want to risk per trade 2%. Yeah? Then you have to calculate 0.02, so this represents the 2%, times $400 makes $8. You can trade and risk $8 per trade if you have an account with $400 and you are able to risk 2% per trade. Yeah? I wouldn't ever recommend to risk more than 2% in a single trade. Yeah? This is maybe a tip on the sideline. Then the second example is, assume that you have a $200 account and you only want to risk 1.5% per trade. Then the calculation is the same. 0.015 times $150 makes $2.25. So in a single trade, you can risk $2.25 if you have an account of $200 and you don't want to risk more than 1.5%. Or the third example, it's pretty much almost the same, you can see. You have an account with $1,500 and you want to risk 1% per trade. Then the calculation is the same. 0.01 times $1,500 makes $15. You can risk $15 in a single trade. So this is the first step with some examples. Was that clear to you, or should we make another example for this first step of the calculation? Now, the risk, the absolute risk in money terms, always depends on the risk per trade per percentage and the account size. Yeah, this is very, very tight to each other. Okay, I see no questions. Then we can go over to the second step. And the second step was the space between entry level and stop loss level. If you enter a trade, for example, a long position, then you should have a stop loss level in mind. And if you have this, then you can measure the distance or the difference between the entry level and the stop loss level. And also here I have 3 examples, pretty simple. If you want to enter a trade at 1.11, and this, for example, could be a currency pair, and your stop loss is at 1.1080, then the distance between these 2 levels is 0.0020, or in other words, 20 pips. Yeah, pretty simple. And the second example could be a stock, for example. The entry should be at 100 and the stop loss level should be at 95. Yeah, and of course the stop loss level has to be at a certain level, for example, a support level or a swing low, something like that, if you go long. And here in this example, the distance between entry and stop loss level is $5. 100 minus 95 makes $5. Or the third example is if you want to enter a trade at 60, and now the stop loss should be at 63. Yeah, sounds a little bit confusing, but maybe one of you can tell me why this is possible. To enter a trade at 60 and the stop loss is at 63. Why is this possible, guys? Don't be shy, guys. Give me an answer. I'm pretty sure one of you knows the answer. Going short, perfect. Yeah, that's right. Of course, this is also a distance between entry and stop loss. If you want to go short at 60, then the stop loss has to be above, of course. And here in this example, the difference is $3. So the calculation of the distance between entry and stop loss level is also hopefully pretty clear. Then we can go over to the third and final step of calculation of the optimal position size. And this is how many pieces can you trade with defined risk and stop loss difference. And again, I have 3 examples here. And this has nothing to do with the examples before in the recent slides of the presentation. So this is pretty standard here. So for first example, the risk in dollar should be $8. Yeah, you have calculated this in the first 2 steps before. And the difference to the stop loss is 25 cents. Then you have to calculate $8 divided by 25 cents, and the result is the optimal position size. So in this example here, it is 32 pieces. And this could be pieces of currency pairs, pieces in terms of stocks, or pieces in terms of bonds or whatever. Yeah, because we are talking about CFD trading. And there you don't have any contract details or specifications. Second example is the risk in dollar should be not more than $3, and the difference to the stop loss is 0.0015, or in other words, 15 pips. Then the calculation is the same. You calculate $3 divided by 15 pips, and this leads to an optimal position size of 2,000 pieces. Or in terms of currency pairs speaking, it is 2 mini lots. Oh, no, sorry. 2 micro lots. Mini lots would be 10,000s, and an entire lot is 100,000. Of course, it depends on the currency pair. So if you trade Japanese yen, for example, then it's a little bit different. But it's speaking in terms of euro dollar, for example, then you have 2 micro lots, or in other words, 2,000 pieces of the currency. And the last example here is you risk $20 and the difference to the stop loss is $5. Then you calculate $20 divided by $5 and the result is 4 pieces. For example, this is a stock. You can trade 4 shares of the company. Was that clear to you? I hope so. And now I have some calculations here for you that we can do some examples. Let me make it a little bit bigger, that everything is pretty clear to you. Okay, so which account size we want to assume? Give me just a number, throw it in. Don't be shy, just a number. Everything between 1 and 1 million. Okay, 10,000, perfect, thank you. And now we want to say what should be the risk per trade. What a number of percentage should I type in here? 1%, perfect, we make 1%. Then the risk in money terms is $100 per trade. We can risk $100 per trade if we have an account of $10,000 and we want to risk not more than 1% per trade. Now, let's say we want to trade stock, and the stock stands currently at 77 bucks, and we want to go long, and our stop loss level should be, for some reason, let's say a support level at 75. Then the difference between the entry and the stop loss level is $2. And now we have to calculate the total risk is $100 divided by $2, the difference between entry and stop loss. And the result is the optimal position size 50. So in this specific example here, the optimal position size is 50 shares of a company if you want to enter the trade at 77, the stop loss is at 75, and the risk per trade with a $10,000 account is not more than 1%. Yeah? Let's do another example. What is the account size? Give me a number, please, again. $1 trillion, 10 bucks, everything is possible. Just give me a number that we can practice together. Perfect, 333. And the risk per trade, what should it be? Risk per trade, 1.5, okay, 1.5. This means the risk in dollar terms is 5% per trade. Now, maybe you can give me here a number for entry level. So maybe you have some currency pairs in mind or a commodity, stocks, whatever. Just give me a number for the entry level. Yes, okay. 1.20. Oh, yeah, you have seen it because it's, let me change this to, so that you can clearly see I have typed in 1.22 or 1.222, and the stop loss level in this specific case, of course, shouldn't be 75, but give me another stop loss level here. Okay, perfect. So it's the same. So you see only 2 digits after the comma. So, but I will change this for you that you can see I typed it in correctly. And this specific case here, it is a short order, and please don't be confused by the minus here. It's just because of the calculation. It doesn't make any sense. So this is the optimal position size in an absolute number. And no worries. That's fine. That's fine, Mike. And now the optimal position size is 45. And in terms of currency pairs, this is not even a micro lot, not even a nano lot. So you can only trade 45 pieces of this currency pair if you want to trade this with a tiny account of $333 and a huge distance between entry and stop loss level. Yeah, this is the reason why the optimal position size is so tiny, because the stop loss level is so far away from the entry level. Yeah, so this is the only reason. Okay, I would say a last example, and then I can show you something different on our homepage. There you can find much more about money management. So just a last example to practice the knowledge you have now. Give me an account size as an example, please. 2,000, perfect, thank you. What should be the risk per trade in percentage? 2, perfect. So this means the risk in dollar is $40. And what should be the entry level? Okay, 141. This stop loss level in this case. $139. Okay, this leads to a difference of 2 cents. And just as an additional information, so we are talking here about a US dollar account and trades with US dollar. If you make a trade, for example, in euro, Japanese yen, euro, Great Britain pound, or Swiss franc and euro and so on, then you have to consider the currency rate between the account and the trade. So this is a thing you have to consider if you trade currencies. Okay, in this specific example here, the optimal position size is 2,000. Or in other words, 2 microlots for this last example here. So hopefully this was clear. Do you have any questions about the calculation of the optimal position size? Then just let me know in the chat box. Otherwise, I will close at least this window here. And I give you here this lesson of our money management course. And here, for example, you can see the formula as well. Let me make it a little bit bigger for you. So this is almost the same formula, a bit more complicated. So I break it down to 3 steps to make it easier for you, but this is pretty much the same. And you can find all of this, for example, and much more in our Protect Your Capital, Don't Go Broke with Good Money Management course. I also give you this link. And if you have any further questions or you see the video right now on YouTube, then you can contact us, of course, at any time under support@tradimo.com. And yeah, this is pretty much it. If you don't have any further questions, then I would say that's it. And I wish you a nice evening. Practice this on a demo account, for example, with XM, one of our partners. And yeah, hopefully we will see you next week. Next week, the topic of the webinar is oscillators. So RSI, Relative Strength Index, and the stochastic indicator. And yeah, maybe I can see you there. If not, yeah, enjoy the next days and weeks. Have a nice evening. Bye, guys.